When you analyze banking industry, you have to ask few questions. And main questions you need to ask are, first of all, what does the bank do? What sources of income does it have? How much does it earn from these sources? And what risks does the bank have and how they are managed? And of course, after that, we look already at share price and your return on investment, the quality of it. Okay, so majority of people they see banks only as retail banks. And we'll start from Wells Fargo. Wells Fargo, it's mixed bank. It used to be time when people couldn't open accounts with them, but let's go here. So, type of banks. Of course, that's kind of not exact um, like classification of banks. Sometimes you can get different classification of banks, but just for our purpose, for analytical purpose, I divided this into three categories. First, it's retail banks. Now, retail banks, that's what we see every day. Okay, they provide loans for people like short-term loans, long-term loans. They provide mortgages. You use them in order to do money transactions between yourself, between people like organization. They issue credit cards. They help small businesses, etc., etc., etc. So that's what you meet every day on a daily basis. Investment banks, they're different. Okay, sometimes you can't open account in investment bank, and investment banks they have different type of business compared with retail banks. And like I identify here five of them. Again, you can break them down on a smaller kind of functions, but these five major would be easy to understand. So first of all, it's trading. So prop trading. When the bank using their funds or funds of other organization in order to invest or trade. And probably you've seen few movies when banks invested or over-invested and create some mistakes, and few years return was perfect, and then 1 year the return was really bad when they, for example, expanded their leverage level and then made mistakes or they changed their traders and etc etc. So when we have bank which is trading, we we cannot guarantee that results will be exactly the same as last year, because nobody can guarantee if you trade and you change trader that the new trader will perform in the same way. So that's kind of risks which we experience here. The next one is market making. Market making is pretty good one from the income point of view, because like if you compare with for example, you have shares to sell, and if right now nobody is going to buy those shares, so this type of banks they're going to buy the shares for you, so they create the market. It's similar to car dealership. Imagine that you have an old car and you want to sell it. You go to this dealer and he buys it from you because he knows that he can sell it for the higher price to somebody else. And similar, if you are trying to buy the car, you're not going to try and look for a lot of people. Probably you're going to second-hand car dealer and you can find quite a lot of cars there straight away. So market making is similar stuff but only with financial assets, so shares like bonds and other securities as well. After that, investment bonds, they also, it's called Me&A advisory. So they help huge businesses buy other businesses or to create mergers. Now, they help not only to do it legally, but also they create audit, like they provide audit of both companies for each other, that they do it in a proper way, they do advice, etc., etc. And can you imagine if there is a deal of few $1 billion, bank gets quite big fees for that, quite a lot of fees. But again, if you understand this type of income, it's not guaranteed. So this year, maybe few companies they created acquisitions, but maybe next year they are not going to do that. Okay, so we need to understand that if market making is pretty stable income, whereas prop trading and mergers and acquisition it might be there, it might not be there. So it's kind of it's irregular income. Now another one, it's new issues of bonds or shares. Now imagine if one company is trying to buy another company and they need some financing for that. So bank can help them to, for example, issue new shares in order to get more kind of funds from shareholders, or they can borrow this money using bonds. So if the company creates bonds, banks as well help them to facilitate these type of actions. And of course, very often what they do, they help them to sell it. So for instance, if one big company they issued 1 million new shares, but right now there are no people on the market who can buy this 1 million shares at the price of issue. So bank, what it does, it's actually buys all the shares for the fee from that company and then release them slowly on the market based already on kind of certain activities. Okay, not like throw all the amount of shares on the market. Otherwise, it can push the price down quite a lot. So they do it properly. Okay, it's not an IPO. It's not IPO. IPO when it's the company just starting. It's a new startup. Uh, they do IPOs as well. They happen with IPOs as well. But mostly, I'm talking right now when the company already has shares. So, for example, company has 10 million shares, and they decided to increase the amount of their business, and they want to buy another company but they don't have money in order to buy. So they have two options to go and borrow $1 million, for example, if we assume that one share is $1, and or they can issue another 1 million shares with a price of $1. But if they try to sell this 1 million shares on the market on the same day when they issue them, they will drive the price down, and the price of these shares they can go like to 80 cents, for example, which they don't want because in this case they will get not $1 million but only 800,000. But also they will drive the whole share price for other shares down as well. So what they do, they sell it to the bank. The bank slowly, like within several weeks or months, release these shares on the market. Okay, then another one, what they do is structuring financial products. This type of banks, they create the product. So when you go to the bank and you can see, for example, different conditions. If you put your money for 6 months, you get this type of return. If you put for 1 year, you get different type of return. So from banking perspective, it's two different products, and you are buying them. You buy 6 months, you like putting money in the deposit for 6 months and don't touch them, or for 1 year, right? And there could be insurance products, uh, different type of mortgage products. When you go in and getting a mortgage, you probably see that different banks they have different conditions, and all that is developed by investment banks. Okay, and then of course we can have mixed banks which have both functions, retail and investment. And interesting enough that in United States, at least as I'm aware, that they're trying to separate it. They're trying to make these two functions separately. And the reason is very simple. So if you're a private investor and you're investing in a bank, you expect it to make from the first part, and that's kind of stable. Okay, so because when you if you are the bank and you are giving away some loans or mortgages, usually they are backed by securities, for example by your house or by your business or by your income, whatever. So this is kind of more secure income, although there are failure here as well. So like remember 2008 when a lot of mortgages, bad mortgages was given away and people couldn't pay money. So in this case, of course, that would be bad practice, but at least now it's regulated and banks strict, like more strict when they're giving money. Whereas the second part, it can jump up and down. So the investment bonds they can make a lot of money, but at the same time next year they might not make money at all and create losses. Okay, and they have huge expenses here because people who work in this area, believe me, they get very high level of salaries and bonuses based on what they do. Okay, that's type of banks. And Wells Fargo right now, it's mixed bank, so it has both functions. So they have both type of activities. Okay, and that's important to understand when we analyze the bank.